Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and today, for many of my old Wall Street colleagues, I may be speaking to your old prof. Dr. Chris Geczy has been on faculty in the finance department at UPenn's Wharton School since 1997, where in addition to being an adjunct professor of finance, he currently serves as the academic director of both the Jacobs Levy Equity Management Center for Quantitative Financial Research, that's a mouthful, and the Wharton Wealth Management Initiative. Chris has also played an important role in developing curriculum over the years, including the school's first courses on hedge funds and sustainable investing. So his interests are varied and his experience is deep, and today we're going to talk to him about his latest focus, the application of AI within the investment industry. It's a topic we've touched on a few times in the past year, including chats with Morningstar CEO Kunal Kapoor and FactSet's head of risk research, Ivan Maitov. And I'm excited to broaden the discussion today. Welcome to the show, Chris.
Thank you so much. I really appreciate your hosting me.
So, Chris, you've been watching AI evolve for a long time. What's that history look like to a quant and academic like yourself? Like, how did we get here?
Yeah, thanks for the question. It's a great question. For me, it goes back to before grad school and in grad school where we were looking at things like neural networks. NLP natural language processing came pretty quickly thereafter. And I actually did a project with Daniel Diermeyer, who's a well-known academic and practitioner, who's now the chancellor at Vanderbilt, but working on NLP early extraction around the turn of the century, a little after that, on understanding large unstructured data sets and how it forecasts volatility and how it can potentially identify the outliers that you care about in the tail, which of course is tough because you don't see them every day, right? The average day is not the worst day, thank God, but really important data on the tails. Early warnings, in other words, really drive a lot about the world. And so where we've come today through large language models has been through this pathway that really tries to characterize the information that is not obvious every day.
Great. So let's talk about where we are today, about the applications that are emerging for AI, because they're kind of across the board. And what are you seeing out there?
Yeah, it's in almost every area that we touch. We did recently at Wharton held a task force on sort of the potential of artificial intelligence. It was a private roundtable at Wharton under the guise of our forward-looking research called the Wharton Future of Finance Forum. And we had folks from around the industry as well as folks from Penn and Wharton, from the law school, from finance, from marketing, and so on, and covered a lot of different areas. Yes, the language models, but also the ethics of it, how AI can lead to efficient optimization and strategic collaborations, innovation use cases like liquidity management, areas of the back office like reconciliation, task automation, but also insights for where we're seeing consistent errors. And overnight reconciliation is one big example. Just example after example in our profession, back office, middle office, front office, buy side, sell side, regulators, all keying in on similar functionalities, but coming back to those principal ideas of dimension reduction, insights that you don't already have, including early warnings, efficiencies, and ultimately open and ongoing questions of ethics.
Right. And when we chatted in the green room a while back, and we talked about hedge funds, you gave me one good example on that I'd love for you to share about the signals that we can extract from a data scraping and refining that wouldn't necessarily be possible without the aid of an AI.
Yeah, right. So we can extract a lot from structured information, a book value for a company, shareholder common equity list, balance sheet diverse taxes, plus some adjustments. Okay, we know a lot about that. It's very regularized. Earnings have probably become less informative over time, but it's very structured. Unstructured data could be things like the tone used in annual reports or the consistency of the tones of people who are speaking on conference calls or the lack thereof. Personality typologies that can be extracted from people's language. One of the things we talked about was from a stream of research that really kind of started in the Journal of Economic Research a few years ago, where some authors and their co-authors started to scrape facial images of executives and found that when certain members of the C-suite team had certain characteristics, notably testosterone markers, there was a greater statistically and economically significant and reliable tilt into accounting aggressiveness, and in some cases, options backdating, and the probability of having an SEC enforcement action. These are things that analysts probably have picked up personally over the years, but what all the technology is allowing us to do is reduce the dimensionality of it. And it's an exciting thing. It's a little bit terrifying to hear that.
I was just going to say, like, machines are listening. They can look at you and tell from your expression on your face the levels of testosterone and your willingness or potential for pushing the envelope. That's nuts.
File it under the nuts column. It's not like it wouldn't necessarily happen, right? I mean, I remember a good friend of mine, John Wishnick in Chicago, who was at the Board of Trade as a part of the local group years ago, telling me, he's a trader and his brain really is a complicated neural net. So, we've always been doing it in a sense, but now it's becoming regularized and empowered. The speed at which it can now happen is absolutely daunting because of the compute power that's given rise to much of the advancement of technology. And also, and this is something I think we don't really talk enough of, although we know it and it's critical, are the data. You just mentioned unstructured data, really images. That's one example, but all the other things that go into that, geospatial data. One of the cutting edges for financial advisors and wealth advisors and planners is even epigenetic data, which is really an edgy area because of all the privacy concerns. But, assessing the possibility or the probability, even a low probability of something health-wise coming out in a bad way, that can be assessed by spitting into a test tube or other extraction of other biomarkers. This is all in the domain of finance, both on the buy side, the sell side, the wealth management side, the planning side. When you think about the big picture, those data will ultimately be online for us. And again, it may be protected, maybe individual, but AI is the window, is the lens for dimension reduction there as well.
And even just in the research process itself, a little bit more kind of in depth, the ability of AI to ask questions and gather and think to ask questions and gather data more widely. I know we talked about the CEO for a bank that they looked at, one of these investment managers, noticed that by reading a regional article about him that he hadn't moved, which told them that, okay, maybe he isn't actually planning to ingest this bank. He was planning to, package it up and sell it off again, right? Which is kind of the next level on that.
Yeah, and there are questions about data privacy, and the regulators, of course, are, much to their credit, thinking about how to regulate it, although I don't think it's all finished by a long shot. In the States, the SEC has its so-called conflicts rule that is getting, I don't know if adjudicated is the right word, but it's in revision, I guess, in the court system and so on. But the idea that you could extract and bring together different data sets, I think it's a little bit under what we would call the old mosaic model, where you could put together immaterial information in small bits and it becomes material in some way. You can see the mosaic when you put the little bits of data together. But that could be things like geospatial data, looking at the flow of tankers on the oceans, or looking at identifiers for airplanes and activity. That could be macroeconomic, it could be microeconomic, looking at something like same-source sales, but extracting it from counting cars in the parking lots based on satellite images. Now, today, this is actually pretty old concept. What's new is both publicly and privately available data that can be incredibly valuable outside traditional analysis. We get asked whether it's going to give anyone an advantage. The other side of that, of course, is maybe markets will become more efficient.
Yeah, well, it feels like it can only push us that way, right? If the definition of market efficiency is all known, all data known to all people instantaneously, feels like a giant leap towards that. Just maybe not great for active managers once it's all known by everybody, right?
Yeah, maybe. So it's this really interesting question, right? We've been doing this for a long time, and I think many of us have tracked the unfortunate passing of Jim Simons, perhaps one of the greatest quant managers of all time, judging by reputation and the information we have. But the kinds of outsized returns you hear in the news for the Rentex Medallion Fund, 60% annualized since the 80s. That's gross of fees, something like that's in the news. I'm not repeating anything here that I shouldn't repeat, but how do they keep doing that, even though we've been clearly spending billions, if not more, on AI and the data for decades now? And yet someone still makes money. The efficiency paradox that Sandy Grossman wrote about many years ago essentially says that markets need to be just inefficient enough to pay people to make them efficient. I think the real question is, who will that be? And if you're an active manager, how can it be you? Someone has to win, because that's how markets pay people. On the other hand, although I love my mother-in-law, it's probably not going to be my mother-in-law who has the marginal advantage. I think it's not really if you're a quant, but how. And I think it's not if you use AI in those kinds of data, but how and when.
And I think about the different hats that folks in our industry wear, right? So we talked about, active managers. You've got, you got investment bankers as well doing deals. You got due diligence you want to do, either that's, especially if that's on a private firm. How does that look to you in terms of how AI might be able to provide an early warning system, for example?
Yeah, it's really interesting. And I've been involved, I should give this as a disclaimer, in a number of these efforts, including at firms like Photon Insights, but also watching many others. One of my former students started AlphaSense that many people use, and others. I think the issue that we have is that if you think about the information that is in the price of a typical stock, well, it's stuff that's publicly disclosed. Presumably, depending which country you're in, there are various levels of information that is harder to understand, and in some countries insider, in some countries not insider information. Again, not all insider information rules are the same across countries. But then the question is, how do we understand all the incredibly large amount of data that is in the tail? How do we find the outlier? Once the outlier becomes an inlier, it might not be as interesting for us. It's like in the old days, people used to do statistical analysis and trading strategies by winsorizing the data, or cutting out the outlier. One of my professors at Chicago, also, Arnold Zellner, used to say, never do that. That could be the most important inlier you have. It's just that we don't have very many of them compared to the center of the distribution. Even though tails are heavy, the center of the distributions are still peaked. So the question then is, think about it, statistically or by logic, how can you find what is in the tail that's really important information, but you don't see it much? I think there are increasing uses of AI to find that tail, to find it in the news. Like you mentioned an example, something that's incongruent with perhaps your initial perception. An executive is not living locally with the organization they're running. Well, maybe that means something, like they're going to sell it. Or there are associations, like network associations, which turn out to be important. Some of the research says that, well, for companies and for, by the way, sell-side and buy-side personnel, whom you went to school with and what network you exist in affects your investments. Those are really hard for humans to see. And a way of thinking about the research side of it is to just compile information and put it all together. On the private side, I guess the good news is, in some sense, you sign an NDA, then you get inside information. And it's not a publicly traded firm. So, you're buying a company, you're buying into a company as a venture capitalist, say, you're going to take a look at a lot of information others may not have. But you still may want to know about the background of the firm. You might want to know about the background of progenitors. You might want to know what the patents are. You might want to know if there are news stories that relate to it and who the competitors are. That historically has taken a huge amount of work. Today, using AI, it can come to your fingertips very rapidly. That's why I get so excited about the things that I'm involved in, because imagine, many, many years ago, it would take days and even months to write research reports. Now, not only can you gather the data very quickly, you can actually start to extract insights and interact with the data. One of the founders of that firm I mentioned, Photon, likes to say, Hari Rabi likes to say, you get to chat with your information, which historically is just not even a concept.
Yeah, I wanted to talk to that, and that's this idea of the democratization of the analytics. Because I know you mentioned the listening to the voice, the earnings calls, and drawing conclusions out of that. And I know, Credit Suisse had their own kind of project on that, I don't know, it's called 10 years ago, a long time ago, where they were sort of doing their own digging on that. And it was, limited to Credit Suisse analysts and maybe some of their clients. And then I chatted, as I mentioned, with Kunal Kapoor over at Morningstar a few months ago. And, they've built their own kind of gated product with their own coders to have a look at the Morningstar reports and the analyst ratings and give their clients something that's sort of within their own universe. But anybody can do this, right? Anybody who's got a bunch of content that thinks is worth using can generate their own, use ChatGPT and do that. And similarly, we had the fellow over at FactSet talking about how they use it to just basically throw ideas at a wall, and it generates all the code, and they can sort of tweak it and figure it out, and 2 weeks becomes 2 days or 2 hours even. Can you talk a little bit to that, a bit to the democratization of it across all thinking minds out there in the investment industry?
Yeah, I like it a lot, in part because it's a functionality that has a lot of different uses. The idea that you could be extracting information now using techniques that are available, frankly, relatively cheaply compared to maybe even millions of dollars that you'd have to pay many years ago, whether that's a no-code or a low-code solution, or it's actually a solution where someone's writing or the system's writing code for you. The cost has gone way down. And again, I feel like, given the stuff that we've done at Photon, it's like if you're not doing it, you sort of have to feel terrified if you're going to try to be an active manager, or, by the way, a really good index manager or an active ETF manager. I think the information really, really matters. And by the way, that could be not just on what we often think of as very high frequency or low latency information, but even things like ESG. ESG is a really interesting area for the application of AI because, as you probably well know, there are all kinds of rating standards and there are all kinds of rating companies. One research project showed that there were maybe more than 150 different standards and rating companies. And there's some big ones, right? And there's some small ones, but a recent paper, the Review of Financial Studies, suggests that the correlation across those is very low. So the question then is, how do you actually decide what an ESG rating is? Well, maybe the dimension reduction capability of AI is exactly what we need. And we've seen some early technologies tilted into that.
I wanted to turn and talk a little bit about risk here. I had a chance recently to talk to a handful of cybercrime detectives, actually, in cities across Canada. We had them speaking to our clients at my firm. And one of the things they all talked about was the use, or I guess rather the constraints on their use in the police force of AI due to public concerns about the misuse of the technology, mainly that the models for things like facial recognition might be trained biased data or by coders with an unconscious bias. So can you talk a bit about the risks of AI, both to its continued growth and effectiveness as an application, and to the risks to us as users of it?
Yes. Look, that technology has been available for a long time. We know that as well, maybe as long as a decade, for reasonable and accurate uses of it. Once again, we harken back to very traditional questions of what your rights are. And in an open society, how do we actually operate ourselves and govern ourselves? If you stand outside a retail store and you see people coming out, you could look at their faces, and maybe you wouldn't necessarily know their identities. You can judge something about them. You can look at them, you look at their clothes, look at their shoes, look at the cars they drive, look at the stores they come out of, the bags they're holding, expressions on their face. These, I think, in many jurisdictions will be just elements of operating in public and following under what might be considered personal God-given rights. On the other hand, this could easily tilt into the kind of monitoring and characteristics we have nightmares about in an open and free society. I think a lot of those questions have still to be answered because the capabilities have gotten so strong. It can be already on the light side. There are crossing cameras or intersection cameras. For example, in Washington, D.C., I think the statistic was there was a camera, I think it was on Constitution Avenue, where 1 year it earned $1 million. I'll have to fact check this, but I think it earned $1 million in tickets.
Wow.
Well, is that for the greater good? It probably is for the greater good. On the other hand, was it disclosed? Should it be disclosed? And then all this other stuff about facial recognition, being able to look someone up, has a counterpoint, which is the other side of it, and the ability to fake your voice, right? Which is now a technology that is possible, and create images of your likeness that, for a human anyway, are indistinguishable from the true image. That's pretty daunting.
Yeah, that was one of the ones that they talked about, was just the evolution of the grandparent scam, right? The old scam where an elderly person gets a phone call, person claiming to be from a jail and saying that they have your grandchild locked up and they need you to send money. And now they scrape the kid's voice in advance and then call you as them and say, grandpa, crying, saying I need money. And they take that to new levels as well as with the deep fakes. They could even be on a FaceTime call. Anyways, that's a little bit of the kind of dark side of it. Maybe if we can pivot back to the investment side of it and just talk about the dependability of the outputs, maybe that as a risk, like in terms of understanding what the sources are, to the extent that they're citing sources, like where are we in that evolution? Because that seems like a natural place for these models to go.
Yeah, there's been some controversy about some of the major players on how they actually train the data and train the models, rather, what data they train the models on, and on whether the people who own the copyright on those data were notified and so on. So we've seen that in the news. We've seen it happening. The models need data, and there's no question about it. They need presumably real data, although there's a whole area of study on creating simulated data for the models to be trained on. In order to have a lot of parameters in what is really basically conceptually, philosophically, one huge regression that can forecast the next word, given inputs and given concepts, you need just a ton of data. And collecting those data are expensive, and there are open questions about how to get it. The other thing about the models is that they overfit. By definition, they overfit. And as you well know, it's a very classic thing in finance and in our profession, because it's really easy to beat the past. I mean, we can beat Warren Buffett in the past. The question is, can we do in the future? And
what do you mean by overfit? Maybe.
Sorry.
Listeners.
By overfitting, what I mean is that you can easily predict what you see, but the out of sample or the next prediction may not be good as what you thought it was, because you've squeezed the blood from a stone, in the sense of just looking for whatever tells the story of the past. We naturally do it, which is why we often say past performance is not indicative of future results. We can find strategies that work in the past, to make it an investment example, that have nothing to do with the future. And in fact, unfortunately, academics and practitioners alike are rewarded for finding things that work in the past. Judging about how those work in the future is really the key question, especially because the world doesn't stand still. The models and their now hallucinations have that characteristic. And if you don't believe me, especially some of the older versions of ChatGPT, and I don't want to necessarily pick on ChatGPT because it's so incredible, but go back and just keep asking questions about yourself. I found out when I just ask questions about myself, you just keep doing it, or ask it about a colleague. Pretty soon, you'll be winning the Nobel Prize, and you'll in academics, I'll publish papers that I'll be publishing papers that I actually never wrote, and those
fantastic,
yeah, goes right into my resume.
Ooh, that was easy.
Yeah, they will give you answers. They unless they're constrained, and once you start constraining them, you wonder what's being left out, because there's no easy way to both be constraining and also give you information that is salient. It's a very tricky statistical question, once again, in the tails of the distribution.
So the very recently here, ChatGPT 4.0 was launched, and so that model will tell you in person how wonderful you are in terms of your accomplishments, maybe that were hopefully the new model doesn't have all wrong information in it. But I wonder if you could talk a bit to the new launch, to that, keeping in mind, acknowledging that it's very brand new, so maybe you haven't had a chance to really play with it.
Yeah, it's new. Some of our colleagues at Wharton have started to do things with it, and we've worked a little bit with it. It's an incredibly powerful step forward for the GPT collection. It has, let's call it, more parameters, more capabilities in terms of the service suites that's around it, ways to interact with it, including the ability to have voice interactions, which is different from the previous versions. It's faster, and it has just basically deeper capabilities. So, for example, one of my colleagues, Ethan Mollick, whose blog is really amazing, just posted something today where he fed in a zip file of a couple spreadsheets with a couple tabs, and basically asked the most recent version of GPT to analyze it using advanced statistics and give him output, including statistical analysis and graphs, basically something like that. And it unpacked it. It essentially taught itself about the spreadsheets, and it proposed and carried out some analyses. Now, the issue that I've had when I was trying the same thing is that it may not give you the analysis that you want, but it also may give you analysis that you didn't think of. I think let me make a high-level comment. The benefit of it is the ability to get better results that are faster, that may be deeper, in many more languages, for example, that the previous versions had. You can have really complicated situations. Those are called tokens, and basically a concept or the idea of a concept can be longer and deeper. But at the end of the day, the question I think is that how you want to operate? So again, it's not a slight at this model, which is life-changing in a way. But then the question is, how are you going to use it? To me, the current future is not becoming a prompt engineer to trump all of the prompt engineers, but to having the technology know what you need to know, even if you don't know it. And I think there's a little bit of a divide there. There's a stream of users who are becoming really good at asking questions with the new technology. I think the other side of it is, in a world where we're still human, we still have a lot of things going on, we still want those deep insights, the so-called machines and algos and AI will be better at asking the right questions. I think there are two things there. One, designing technologies that know what questions we want to ask and we should ask, even if currently we don't know it. And the second thing is, let's call them chatbots talking to one another, or AI bots that are very specialized, interacting so that the end solution involves iteration across different purposes. And that might be, an ideation model, and a testing model, and an implementation model, and a QA model, and an explanatory layer. These interactions might actually give us kind of a deeper sense of it. We've done things called RAG, which is a way of pre-processing data. It's called retrieval augmented generation, where basically a technique that combines large language models with structured data to generate outcomes that is factually accurate and relevant for a context. So it's like pre-processing, like I mentioned, and then going into the AI and then passing it through in an explanatory layer. A little high level here, but the basic idea is that there's an internal component that makes it better for the user, and the hallucinations are less likely in that case.
So we're coming to the end of our chat, unfortunately. Chris here, I'm wondering if you could tell us what was your first job in the industry, and if you could go back and take yourself for coffee on your first day, what key piece of advice would you offer yourself?
So I would say I had two jobs. First in the industry was when I was an undergraduate. I wrote the software for a macro textbook, but my focus really was on the asset markets. So for those of us of my age, we might remember the Dornbush and Fisher macroeconomic textbooks, and I wrote the software for it as an undergraduate. But what really intrigued me about it was the financial sector. Then I worked for the Fed during part of the Greenspan regime, and we re-estimated the Fed's macroeconometric model. And I was a part of an amazing team that did that. And part of what I was responsible for was helping on the financial models. And that's what opened up both the beauty and the challenge of operating in the financial space. Again, that's a little more academic, but it led on the practical side and the industry side, as well as in academia. And it might, in a conversation about AI, it might surprise you. I don't know, maybe you feel the same thing, but I think I would work really hard if I were to talk to myself and take myself for coffee to impress upon an earlier self how important human connections are and the network is. And, I've always been an area where individual accomplishment has been rewarded. And that's true in financial practice, although I've also done work in the advisory side. I would tell myself to continue to find mentors, and I've had some amazing ones, continue to put work into mentoring others, but also remember that network is there and it's really important. And by the way, that's one thing CFA Institute does, is provide incredibly powerful networking. At the end of the day, that provides a huge amount of alpha.
I've been speaking today with Dr. Chris Geczy, Adjunct Full Professor of Finance at the Wharton School of the University of Pennsylvania. Thanks for chatting with me, Chris. It's really been great having you on today.
Thank you.
I'm Mike Wallberg, and this has been The Enterprising Investor.